Brokers Digest, a webcast series by The Edge Singapore, discovering market opportunities with you. This episode is sponsored by Phillip Futures.
Hello and welcome back to another episode of The Edge Singapore's Brokers Digest with me, Amala Balakrishna. It's been 2 weeks since our last episode, and there has been quite a turnaround in the US markets. A contributor was the blowout jobs report released by the US Labor Department, showing that 916,000 jobs were added in March, compared to the 675,000 that was expected. Another push came from the details of US President Joe Biden's $2 trillion infrastructure plan, which, in his words, makes a once-in-a-generation investment. Major stock indices responded positively, closing up before the Easter weekend. The Dow edged up by 0.29% for the week ended Thursday, 1st April. The tech-heavy Nasdaq was up by 2.6% in the week, and the S&P 500 was up 1.1% to hit a record closing at above 4,000 points. Joining me today to break down these movements is Mooris Tjioe, an analyst with Phillip Futures. Hi, Mooris. Happy to have you with us today.
Hey, Amala. Thanks for having me back on.
So, Mooris, what do you think about the US market's strong performance last week?
I quite liked the movement last week. Why is that? Because it's quite rare nowadays that the stock market goes up at the same time as the economic outlook. So it's pretty good, I would say. Economic outlook is picking up. The jobs report you mentioned actually kind of was a very, very positive surprise to a lot of people. And kind of in the past, what you used to see is the moment there's a positive surprise, then there's expectations of a tapering. Therefore, the stock market suffers. So this didn't happen this time. So I'm quite happy about that.
So, Mooris, a question a viewer had for you was, is this a good time to invest, or should they wait it out for a bit?
So this question, I think, you can't ever really get a straight answer, yes or no. But what you can lean on is the probabilities, right? So if you were to look at probabilities, so the Nasdaq, what happened to it when it went down was perhaps a 10-11% drop from the peak in February. So that doesn't even meet the definition of a bear market, right, which is negative 20% sustained drop. So with that in mind, right, I think that it's just my opinion, but the general uptrend is still intact. And just for reference, if you look at the S&P 500 and the Dow Jones, they experienced single-digit drops only from the peak, and now they're back at all-time highs. So general uptrends is still intact. And if people don't get in right now, then they may miss. And there isn't really a sign that we are in a bear market yet. Yeah.
Yes, I guess it's hard to say at this point in time. But one thing we saw last week was that tech stocks were amongst the top performers, with counters like Alphabet, Microsoft, and Facebook taking the lead. So there's been mixed sentiment in the market from what I see. So one school of thought is saying that there is no better time than now to invest in the tech sector. But another camp suggests that playing the waiting game might just yield better returns, as the prices of these stocks may fall once inflation kicks in. So personally, I feel that both camps raise strong points, Mooris. What say you?
I think we can start with, say, the Federal Reserve, right? Because you mentioned one thing there, which I'd like to pick up on, which is inflation expectations. So one thing about inflation expectations is, let's say pre-pandemic 2018, inflation was going above 2%, which is, as everybody knows, the Fed is having a 2% target. If it goes above, then they taper, right? Just to bring it back down. Yeah, that's right. So what happens is actually Jerome Powell, he has a dashboard of labor market indicators, which investors need to know. And what do I mean? This labor market indicators is not as simple as unemployment. You're talking about black unemployment. You're talking about low wage earnings growth. You're talking about the unemployment of people who are not, who don't have a college degree. So why is this important? And why is taking note of what Jerome Powell is doing is important? Because these are lessons that they learned from the 2008 crisis, where they kind of did the tapering, or rather they didn't have a package that was there in place it wasn't large enough. And a lot of people were left behind. So Jerome Powell comes from that school of thought where, it's he wants the economy to recover fully first. So if people right now, they're looking at the economic, the unemployment rate, it just went down to 6% because of the strong jobs report you mentioned. So if they're looking at that and say, hey, this full unemployment, but no, that's not what Jerome Powell is looking at. And, any kind of inflation expectations or interest rate hikes now may be a bit too premature because of that. So if you go to the chart that you had we are looking at just now, so it's a bit of a noisy chart, I understand, but let me take you through it bit by bit. So firstly, the blue line at the bottom, that's a NASDAQ, right? Over the last 15 years. So if you look at the green line, you can see that as a proxy for Federal Reserve asset purchasing. So in lay terms, it's really money printing. So you can see that the money printing has been going up, and sometimes it spikes, sometimes it tapers. And for the NASDAQ, it's been on a steady uptrend. But I like to point your attention to the bottom left green box. Okay, so that green box is the subject of what we can see as the Federal Reserve's asset purchasing program, stretching from 2008 to 2018. And what you saw is the NASDAQ kind of really grew a lot, and it's kind of an uninterrupted growth in a way. But what happened if you move on to the red box after that is that, in 2018, early 2018, the Fed started thinking about tapering the asset purchases. Why? Because full employment was nearly reached, and you're talking about inflation expectations. Suddenly, when inflation goes above 2%, then people get a bit scared, right? So they want to taper. But interestingly to me, what happened there is you can see the NASDAQ actually kind of stalled this 10-year rally, and 7% growth when you compare it to the average of 14% returns over the last 10 years. All I'm suggesting here is that there's a bit of correlation here with tech stocks, meaning the NASDAQ, and Fed QE programs. So after that, you go on to the next green box, the second green box, which is, they kind of started it again because short-term interest rates were rising too fast. And then after that, that's COVID. That's the second red box. And the last green box, that's the period we're in now, which is from last March, where the Fed basically said, unlimited money printing. We're going to raise our balance sheet by $3 to $4 trillion. And then suddenly you see a huge rally in the NASDAQ as well. So to me, what's interesting is that, or rather what I'd like to suggest to viewers is that they can think about, hey, is it a good time to enter? Is it not a good time to enter? What should I look out for? Should it be inflation, interest rates, PE ratios, things like that? What I'm saying here is if you are in riskier plays such as tech stocks, you may want to adjust what you're monitoring and really start looking at how does Jerome Powell think. It's to me, it's kind of interesting. Yeah,
that's true. It's hard to, if only we could actually read his mind and see what he was thinking, right? Mooris, maybe viewers and all investors will be able to make better investment decisions. But I think you brought out a very interesting point of looking at the economic indicators when making a decision. So last week and just now, you also mentioned briefly about looking at PE ratios or price to earnings ratios as one way to ascertain the investment worthiness of a stock. I noticed that the PE ratio of tech stocks are rather high. So is it still advisable for our viewers to use this as a gauge, or are there other factors other than the ones that you mentioned earlier that they should bear in mind?
So back to PE ratios, I think one way that is useful to think of PE ratios now is, it's not binary. Is it useful? Is it not? I think the answer is somewhere in the middle, and it's come to a point where PE ratios may not be so useful anymore, but they still have some use. And what I mean by some use, I think PE ratios are useful for discerning between companies in the same sector or the same industry. So when you see companies with maybe the same PE ratios and then suddenly there's one like way higher, all it's saying is that, are you really buying into the long-term vision of this company? That's all. And a reason why PE ratios can't really explain that much anymore, I feel, in my opinion, is because of easy monetary conditions. The NASDAQ, of note, has always had higher PE ratios, although right now you're looking at, by some metrics, it's like 72, the PE ratio, which is really, really high compared to S&P, which is about, say, like 30. Yeah. And another important thing to note, which is in this graph, is that P ratios, they tend to really spike after the crisis for any number of reasons. Lower earnings, higher price, things like that. But you can see that for what we call a great moderation, a bit tongue-in-cheek there, but it actually doubled the P ratios. So back then there was no shortage of people going like, hey, P ratios are too high. Hey, P ratios, there's going to be a crash and things like that. So right now we're also seeing the kind of same reactions for this kind of post-pandemic recovery. So all I'm saying, if I'm saying anything at all, is that it's situation normal, and it's it's not unusual to see higher PE ratios, especially for tech, as probably we'll cover later on, the performance of tech against all other industries. Yeah. So what you're seeing for this chart here, right, is that if let's say I were to use PE ratios as a kind of like one tool in my toolkit of trading indicators, you'll see that local highs in the PE ratios, right, they don't necessarily indicate kind of broader corrections. So it's in a way, all I'm suggesting again is that you take PE ratios as a guide rather than like hey, PE ratios are too high. It's definitely 100% too dangerous to enter the market right now. Yeah. I'm also not saying that PE ratios will go even higher, but that's how you say people have to get used to, again, back to what we spoke about in the previous episode, that PE ratios overall are drifting upwards, right? And that explanatory power of the price to earnings ratio, the key thing is the price there. The price is a bit more and more diluted, to borrow a word, diluted in a way because of external factors like unlimited asset purchasing. So that's a bit extraordinary. And also something interesting in the world of brokerage that's been coming up in the last week is that I think we're all aware that there's been a lot of not a lot of, but there has been a kind of direct check from the government to the bank accounts of American citizens, $1,400. That's a nice round number. And I think there's a lot of reports coming out now that major brokerages, as well as, all right, I'll just keep it to major brokerages, have seen a lot of retail deposits in recent days. And guess what? The most common number for the retail deposits was actually $1,400. So, I wouldn't say directly it's like the money comes from the government in the form of a stimulus check. It goes straight to the brokerage, but certainly it strongly suggests that. Yeah. So again, in a sentence, price probably, there are a lot of factors that will push prices higher, such as easy monetary conditions. Therefore, PE ratios have weaker explanatory power right now, at least.
Right, Mooris. So against this backdrop, you have shared so many insights with us. I have to ask the $1 million question, which is also the topic of today's episode. Are tech stocks something that our viewers should actually look at in the next few weeks?
I think for the next few weeks, if we look at it from a more technical aspect, right, it seems like the worst of the correction is over. And I think, again, playing on probabilities, I think what weighs the odds in our kind of favor, or the favor of our assessment rather, is what was the reason for that correction anyway. So the reason for the correction, I mean, there's a lot of kind of explanations floating around, but the dominant reason for that is actually, if I were to put it in a theme, is actually looking at people expect the economy to recover quite strongly, in fact. So it's, right now there is a sense that, I'll give you two numbers, right? One of it is the one you mentioned, over 900,000 jobs created, beat expectations. The other one is that the US is on track, by some estimates, to achieve herd immunity against COVID in the next 3 to 4 months, which is way faster than people expected in the beginning of the year. So with this backdrop in mind, and you're seeing tech stock prices kind of hold up right now, I think there is some evidence to say that the worst of the correction is over. So in the next few weeks, I think it's a crucial period if there's going to be further corrections, or is there going to be, is this going to be the worst of it you see? And then after that, you see tech stocks start to catch up again with Cyclicals and S&P. So I'll say they have to take that into account. So that's first. Second is, if you look at this chart here, right, you see that, in the long run, tech stocks are kind of doing better than every other industry. So it helps if we take a longer term view for this. Why? I think one thing you'll see during the recovery period now, let's look at the last year, is that a lot of people will notice that some industries like materials, like energy, they're actually doing quite well. But if you take a long-term view, let's say the last 5 to 10 years, you see that they're actually beaten by almost every other sector. So it's quite, how you say, for this, people have to look at it short term, they have to look at long term, and they have to see that tech stocks are coming from this very long runway of doing increasingly well. And other stocks which may look really attractive right now in other sectors, what were they like pre-pandemic? And has anything changed during the pandemic to give you the kind of confidence that they are going to do even better or outperform tech stocks in the future? And I'd say, based on my own personal opinion, I don't really see the evidence. So I'll say tech stocks wouldn't be the, it wouldn't be the worst play in the next few weeks. Yeah, but definitely this is a period of consolidation. So people should calm their heels a bit. We are coming off a near 1 year rally. And then we take stock of announcements coming out. Maybe if we confirm, okay, maybe one clue I can give people is, we confirm the trajectory of economic recovery, which means waiting maybe the next few weeks, next month, for high frequency data to come out. And, what kind of picture is it painting for the economic recovery? How do tech stocks react to that? And then perhaps then we can get a clue as to whether the bottom is in. Yeah.
I think from what you're saying and from what I've been hearing from investors and our viewers as well, the interest in tech stocks largely comes from the fact that the products of these counters are what people have been using. So I think that's why people reckon that they make good investment options, like, for example, Salesforce and Adobe. And these are coincidentally counters that a lot of our viewers have asked specifically if you could give maybe your 2 cents worth on whether they should be investing in them.
I think software as a service companies have been doing very well. But in my own, if I may say, lay view, I think most of their potential has been priced in already. And definitely among them, right? So you can see it as an industry, all of them have been moving up. So right now we're at a high phase where a lot of it is priced in. Why is it priced in? Because everybody has been doing the analysis during the pandemic, and then they say this is what's going to look like in the future. So it's no surprise to anyone that this potential is really priced in. So now we're here. How can people perhaps think about it? My own 2 cents on the issue is, everyone is here, but who's going to break upwards? Who's going to continue on this path? So there are going to be winners from this point where everybody's a winner. There's going to be further winners, if you like, and there's going to be people who don't win as much, to really make it sound quite informal in that sense. Yeah, but you get what I mean. My point is that some companies such as, in my view at least, Adobe, they've been doing some really interesting things where they try to expand their, if I were to introduce a concept into our conversation, is addressable market, right? Yeah, so if, your addressable market was always this size and there's always new competitors coming in all the time, then it doesn't make sense, right? Like, I keep pushing, I'm an investor and I keep buying their shares and be like, they're going to be the dominant leader, but you are not taking into account how easy it is with so much money sloshing around. All of a sudden, one giant company comes in, say Tencent, and they try to disrupt the industry, which is what everyone's trying to look for, the next new industry to disrupt, right? And all of a sudden, your monopoly over that one industry, let's say software as a service, is broken, right? So what people need to think about now is that, companies who try to do more than just be good in one industry, and they're trying to expand across a lot of different industries. And I think those companies are going to do well in the future because, again, it's just, barriers to entry are both simultaneously higher and lower than a lot of people think into certain industries, because all you need nowadays is really a large name coming in, throw in, really billions of dollars at it, and to make a really good product. And within a few months, you see the whole market shares changing again. So back to original question on those individual counters, some counters have been expanding sideways across different kinds of, not really fully different industries, but different capabilities, if you like. And I think those will do well further into the future than those who really just try to keep saying that, hey, you haven't come onto our platform yet. Why don't you come onto our platform? And they keep trying to sell to the same customers over and over again. That's my opinion on it, at least.
Mooris, I would also like to ask about something that you mentioned earlier, which is other than the tech sector, you see that cyclicals is a winner sector, so to speak. So maybe could you share a bit more about this?
Yeah, so for cyclicals, maybe if I pick up on one that we mentioned before and one that's a bit in the news these days, perhaps the banking sector. So banking sector, we spoke about it 2 weeks earlier. And I think it's important to note that for cyclicals, not all cyclicals are the same. So there's two things that are not the same. First thing is between cyclicals, which on the screen you can see a list of some industries. Between these industries, not all of them are going to go up in the same, steepness of the slope, if you like. So that's one. So for the second thing is inside these industries, right? You're going to see a kind of divergence in company performance as well. So that's the other one. So if I were to go back to the banking sector, right? The banking sector itself is a bit different from the rest of the cyclicals because one key thing that determines banking profitability is like interest rates, among other things, right? So they're really, interest rates go up, then their outlook goes up. If interest rates go down, then a big part of the outlook also goes down. So it's not as pronounced for the rest of the industries. So the larger lesson to learn from that for investors is that, yes, there's a cyclical recovery going on, but some industries are going to do better than others. Then the other thing is, talking about cyclicals, right, is it's actually a related point to what we spoke about earlier. So if I look at, say, the listed number one industry there, which is automobiles, say cyclical automobiles. Right now for automobiles, there's a bit of a shakeup. And what am I talking about? I'm talking about, firstly, there's supply disruptions. Those are the big kind of news items. Supply disruptions, and there's kind of a whole push in the electric vehicles. These are two big trends you're seeing inside automobiles. And not every company is kind of dealing with it the same way. Okay. So it's quite curious to me, at least. So let's talk about supply disruptions, right? So automakers, they don't really keep a lot of components on hand, like talking about, say, chips, because it costs a lot of money to just warehouse them like that. So companies have actually secured their supply and some companies haven't. So you are seeing cases where some companies, their production has continued, where some companies, their production is like they're closing plants because there's just not enough components coming in. So that's for the industry itself. For cyclicals, I'll say my biggest lesson for myself, at least rather, is that not all cyclicals are the same between industries, between individual equities. And it helps to look at how these companies, cyclicals in general, have been dealing with kind of things like supply disruptions, back to just now, as well as how they look to the future. Are they really kind of at the mercy of if, let's say, interest rates rise and then my business rises, or have they been trying to diversify their business? And I think that's one thing that investors should take note of, at least for the future.
So Mooris, just before we close, I want to share something that I've been noticing lately, which is that we are approaching the earnings reporting season in the coming weeks ahead. So analysts predict that a 1% change in GDP drives a 2.5 to 3% change in a company's revenue and even larger gains in its profits, which is pretty much in line with what you were sharing just now about how economic indicators are a reflection of how well the stock market may possibly perform. So there's also talk that April will be a good month based on historical trends showing that markets have been up by 2.8% on average since 1990, with all 11 sectors gaining on average. So as positive as this sounds, do you have any closing tips on things that our viewers should be looking out for in the coming weeks ahead?
Yeah, sure. So definitely the past performance does not guarantee future results. I say that a bit tongue-in-cheek, but I think one thing that people need to think about if they don't have one already is at least trading strategy. What do I mean? One way of looking at it is right now you're in a crossroads and you're like, hey, is it going to go up? Is it going to go down? Right? One piece of advice I have for people is to get used to the idea of adopting a trading strategy. For example, very generally speaking, dollar cost averaging, things like that. Don't throw in all your available capital in right now, things like that. Try to average downwards. So if they don't have one already, they have to start thinking about it like that, because no one can, I mean, not me, not anyone can really tell them, is the market going to go up, down, sideways, things like that, you know. So that's one thing that people should really take note of. And maybe the second thing I would probably end off on is US economy is a lot stronger than a lot of people expected. And I think it helps if people have this kind of you can do it yourself, it's like not you specifically, but anyone listening in can do it themselves, where they have this checklist of things that, okay, US economy is strong, what is going to be affected? And I can give you a list of a few things at least that's going to be affected. So your bond yields are going to rise, definitely. Interest rate expectations will rise. Your inflation expectations will rise. So all these things will rise, and then they need to figure out who are going to be the losers first and foremost, and make sure that they are not overexposed to those losers. Yeah. Then after that, they can start thinking about who are the winners. So at this point of time where there's going to be, what's on everybody's lips now is about correction, right? Where there's going to still be a bit more correction to go before this kind of economic recovery fully kicks in. And how you say, people just have to be aware that they don't get caught out by those kind of assets that have gained a lot over the past year as the economy recovers. Yeah.
So with that, we have come to the end of this week's Brokers Digest. Thank you, Mooris, for sharing your insights on the investment worthiness, particularly of tech stocks. To our viewers, we hope these strategies help you in your investment decisions in the short and medium term. For more analysis on the stock market, you can visit the websites of Phillip Futures or The Edge Singapore. Do like us on Facebook and Instagram to be alerted on our next episode on how to trade commodities. It will be jam-packed with trade secrets which you won't want to miss. You can also leave us a comment below if there are any questions or topics you would like for us to discuss. I'm Amala Balakrishna. With me is Mooris Tjioe, and we will see you again in 2 weeks. Take care. Goodbye.
Thank you.